Hi, good morning. This is Cordant's market update for Friday, June 19th. Hope you're all doing well. Just a reminder, we'd love to hear from you on either what's helpful about these updates, what's not, and probably most importantly, what topics you'd like to see us address here. Been getting some comments around addressing inflation and Federal Reserve's actions and the impacts on inflation. So look for us to talk about that in an upcoming update and in our 2310 webcast coming up at the end of the month. So look for that, but keep the suggestions coming. I really appreciate that, and we'd love to hear from you. Today, we're going to cover a few things here. So just a really quick update on the markets, where we are, dive into some of the health and economic data, as that's obviously important given what we're going through in 2020, and then look at a topic near and dear to my heart. Is value investing dead? If you've worked with Cordant for a while, you probably know that we prefer less expensive stocks versus expensive stocks. And you probably also know that value investing as a style hasn't done particularly well of late, especially compared to growth. And so we want to dive in there and take a look at that topic. So that's our roadmap. Let's jump into the markets. And just really quickly, as you probably recall, the drop from the peak in late February was about 34%. Since then, we're up about 40%, which puts us about right at 8% off the peak from February. That's an all-time high. Yeah, and if you watched the video last time, we talked about, well, if we do get back to an all-time high, what does that mean going forward? So that's in the last update. But one thing to point out, last week we had a pretty substantial drop, about a 6% drop last Thursday, and we've since regained some of that. But I think the key thing to note there is, as the economy starts to reopen, as people start to recirculate, one thing that'll probably cause an uptick in volatility is just the health numbers. Are we seeing more cases of COVID-19? And then also, as the economy starts to rebound and we start to get some better economic data, the bar gets raised and it becomes harder to exceed expectations. So all that said, it's not necessarily we're going to go down or up in the market, but I would expect more volatility probably going forward as we're starting to reopen, and there's starting to be some uncertainties around how that goes and what's the impact from a health perspective. So not up or down, but probably expect more volatility going forward until things get a little bit less uncertain and more certain. In terms of health impacts, so this is what I'm looking at here. So what we can do is look at the cases, the number of cases, and we're looking at the United States versus Canada here. And what you see on the Canada has seen a pretty drastic decline here, whereas in the U.S., I'd say more flat. We're kind of looking at a similar number of cases trending down, but a similar number of cases if you look at a 3-day average. So the shape of Canada's chart here is more like a peak, whereas the US, it's more like a mesa, right? We haven't quite declined. So that's, I think, one of the things that are triggering some volatility in the market is, are the number of cases picking up? Are we actually going to increase this? So that's one thing, is the number of cases. One thing that's interesting to look at, though, is deaths from COVID-19. And what you see in the United States is a decline similar to that in Canada. So I think the question here is what's going on. There could be a few factors. So one would just be an increased testing. So previously, maybe just the very sick people are getting tested. Now we've got more people testing positive, but they're not as sick, and so therefore they don't end up dying from COVID-19. I mean, that could be one thing. And the other thing could simply be better treatment for the virus. Something else could be a lag in the data. People are sick and it's showing up, but thankfully, haven't made it to this one yet. And then the other thing that's interesting to look at is age. So Florida's in the news in terms of their cases and things like that there. One of the things that is interesting about what Florida does is they actually publish the data by age. And so what you can look at is cases. I just simply split it at people that are above 50 versus below 50 of age. And you see, since about May 1st, the number of cases in Florida, or the percentage of cases, have actually drastically increased in terms of those that are under 50. So in green are the people that are under 50, and in the gray, people that are over 50. So more and more people that are testing positive for COVID-19 in Florida are younger. They skew younger. And I think one hypothesis here is that as people become more and more knowledgeable, both in the medical community and the general population, about who's most at risk and things like that, the younger population could be willing to take more risk, to be out in public more, et cetera. And so, that's one thing that could be driving the increase in cases, but not necessarily the increase in deaths. And what we're looking at here is simply the hospitalization rate in Florida, again, by age group. So obviously you can see it's about, 4 to maybe 7 times higher, depending on the months you're looking at, for those that are above 50 versus below 50. So if the total cases are increasing, but those that are getting it don't require hospitalization, that might not be as taxing, as stressful on the system as just looking at the pure headline number, how many new people are contracting the virus. So that's one thing that I'm paying attention to, and I think is interesting to look at. And obviously we'll keep an eye on these numbers and how they roll out over time. From an economic perspective, obviously the health crisis plays into this. This was primarily, it's a economic crisis geared by or triggered by a health crisis. And, there weren't a lot of big imbalances in the economy going into this, and it's primarily just driven by the shutdown because of the health crisis. So where are the numbers today? I think one thing that's important to look at is what matters from a market perspective. And we looked at this chart last time, but essentially what these two scatter plots are saying is the GDP growth in this year doesn't necessarily affect the market returns in this year. It's more what GDP is expected to do next year that's going to impact what the market's doing this year. So that's the first thing to consider. And then the second thing is better or worse than expectations. So big news earlier this week on Tuesday was retail sales up 18% almost. I think that was a record. Obviously, that's off of a big drop from last month. And you can see that over here is that, yes, we had a big bounce, but we're not back to where we were previously before this crisis. But again, what the market was up almost 2% on the news. And I think what matters is better or worse than expectations. And so for retail sales, you see down here, it was expected at 8.5%, came in at almost 18%. Some of the other big news, jobless claims came in lower than the consensus. Retail sentiment, again, came in better than consensus. So those are both good. Retail sales we looked at. Building permits came in slightly below consensus, but better than prior month. And home builder index, no consensus there, but it was up big over the prior month. And these last two are important as real estate's a pretty big component or driver or fuel into a lot of other things that go on in the economy. So again, just to sum up this whole section, I would say two things. The health numbers that are coming out, I think are certainly being watched by the market and could be a trigger for some volatility. Again, is it better or worse than what we're expecting? And then on the economic front, again, it's better or worse, but now as the numbers are starting to come out, as things are starting to restart and reopen, what matters is better or worse than expectations, but the bar is getting raised. And so again, becomes a higher bar to exceed. And my guess is we would see some increased volatility as we saw last week going forward as the bar gets higher to hit. So that's it kind of on the update on the market and where we are health and economic data wise. One topic that I wanted to address here is value investing dead. So again, I said at the outset, Cordant has a bias towards owning less expensive versus expensive stocks. If you've been around a while, you probably know that. Also probably know that lately growth stocks have done very well. And it's not that necessarily the value stocks have done poorly, just in comparison to growth stocks, value stocks haven't kept up. So really question here is, what's the deal? Has something changed in the world that would cause value investing not to work going forward? So that's what we're going to dive into. There was a good study published here recently by a company called AQR, Advanced Quantitative Research, and they tackled this topic. And the way they tackled it was to look at a couple different things, and I'm going to go back to it just to set the table here. But some of the critiques of value investing, like why it might not work going forward, would be one, that the price to book ratio just no longer works. So this is a way of valuing stocks. It's what's been done in the academic literature that's saying, let's look at the book value of a company, basically, all the assets, its retained earnings, things like that, and how much are people paying for those assets. So is there something wrong with that? Does that not work anymore? Look at tech stocks. Are tech companies just different? They can grow faster. They can do it with less capital, things like that. It would make those companies different. Mega cap stocks, the largest stocks out there, maybe that there's some things that are in their advantage from a monopolistic perspective right now that would cause them to have a higher expected return. And then just last thing that they looked at was just expensive stocks are different. Like, we're not exactly sure what it is, but there's a reason these expensive stocks are expensive, and maybe that's explaining it. So they kind of took these one by one and went through and said, okay, well, has something changed? Is value investing dead? And so the first thing, just to back up a little bit, is where are we now? So we're looking at that price to book metric, and what you can see from this line chart is basically, the higher the number, the higher we are on the chart, the more expensive the expensive companies are relative to the cheap companies. And what you can see is right now, we're at basically a historical level. The expensive companies are more expensive than the cheaper companies by almost the widest margin going back in history. So you can see a couple periods here. This is the tech bubble. But just looking at this metric, it's expensive. One thing that also means is that this style of investing has not worked very well going into this period. The tech bubble is the other classic example. Did not work. This is going into the last crisis, the global financial crisis. The style of value investing, while when you're up at this level, it means looking backwards, it's not worked very well to get to this level, essentially. So let's go through these critiques, and do they hold up is the question. So the first question they try to answer is there some flaw with the price to book metric? And where I'd like you to focus here is on this column. Basically, where is this measurement relative to the median measurement over history, which is going back to 1967. And what you can see is, and what they're trying to come to is it just a price to book thing, or is there is there something else going on? And so they looked at price to sales, price to earnings trailing, and then price to earnings going forward. And what you can find is basically across these measurements that no, expensive stocks are expensive no matter what you're using, what metric you're using, compared to the less expensive stocks. And so if you're looking at price to book, they're as expensive as they ever have been. They're the 100% above, or the most expensive. Price to sales, price to revenue, 21%. This is kind of the outlier, but later in the study, they adjust it for industry. So you wouldn't expect all industries to have the same metric. So when you adjust it for industry, it actually comes back to closer to where some of these other metrics are. But price to earnings, either trailing or forecast, still expensive. Then they're going to go through and look at, okay, let's start removing things. So maybe the tech companies are different. So let's take those out and let's look at the rest of the companies. And do we see something more normal in the data? And again, what they find is you go through each of these things, and no, even if you strip out tech, media, telecom, some of these, fast growing, low capitalization need companies, the rest of the universe, the expensive stuff's still expensive relative to the less expensive stuff. If you strip out mega caps, the largest 5% of the companies, no, things are still expensive relative to history. And then just strip out the most expensive stocks. Maybe they're different. Maybe they're going to be able to grow faster, etc. Again, no, still going back to history, the most expensive stocks in the rest of the universe are still expensive relative to everything else. So, I thought this was a good treatment of, okay, has something changed? And it's essentially the answer is no. Kind of the last thing that to look at here is, well, maybe the value stocks are just cheap for a reason. Maybe they're bad companies and they're cheap for a reason. And so what they looked at is leverage, which isn't on this chart. They return on assets, and they looked at profitability. And what you can find from a leverage perspective, these value companies are actually less levered, less debt than they've had historically. The companies, the return on assets, meaning how much do they generate based on the assets, is right at line historically. I think it's right at 4% versus 5% is the historical average. And then profitability is basically 17% versus a history of 17%. And what we mean by that is the 4% is 4% worse return on assets than the growth companies. Profitability 17% lower than the growth companies. Now, value stocks are typically are going to show up lower, right? You can see that, but you get paid for that. That's part of the value premium. And so the question is, are they better or worse than they have been historically? And they're basically in line, or they're maybe even more competitive with growth stocks if you go back and look at the history. So again, just to kind of sum it up, if you take some of the things out, technology, largest companies, profitability, things like that, historically value still stacks up well relative to growth. We're just going through one of these periods that we've seen before in the data. So their conclusions, and I would say I would agree with these, are basically, if you look at the medium term to longer term, the odds are, and what they say is rather dramatically on the side of value, meaning your odds are in your camp to invest in value. However, timing is really hard. We don't know when it's going to change. We don't know if it's going to change quickly or slowly. Sometimes these things come back very quickly. After the tech bubble, they rebounded the next, I think, year and a half, and it kind of reversed this whole period. Can come back quickly, or it can take a while, but we don't know. The pain of this, kind of how they phrase it, is, and because timing is hard, is why this doesn't get arbitraged away. It's why this would be expected to still work going forward, in addition to some of the other stuff that we looked at. And then, their final conclusion is, if you do own value, if you're a long-term investor, stick with it, which is, of course, not is easier said than done, but that's kind of the conclusion they reach, and that's what we would recommend as well, obviously. So that's it. Hopefully this is helpful. If you want to check out the paper, I put the link here. It's simply "Is Systematic Value Investing Dead?" is the name of the paper, and it's by AQR. It's technical, it's pretty long, but if you want to dive deeper, check it out, or reach out to me and we can have a conversation about it. So that's it for today. Again, please let us know any topics that you'd want to address in the future and any feedback that you have, and appreciate you watching, and have a good weekend. All right. Thanks, everybody. Bye.